All right, this is exercise 8-7A, and we're talking about just recording depreciation expenses. The Gulf Seafood for the year one fiscal year started up, so they started in business by taking 60,000 cash from an investor and issuing common stock. Then they purchased a new cooktop that cost 40,000 in cash. They earned 72,000 in cash revenue. They paid 25,000 cash for salary expenses, and then they made an adjustment for depreciation for the year. Okay, and they're using straight line depreciation on here. I'll record the transactions, but we probably need to do the depreciation first. Straight line depreciation, there's a simple formula for it. Straight line depreciation the yearly expense is equal to the cost of the product minus the salvage value, whatever you're depreciating, divided by the useful life. So the straight line depreciation expense for this cooktop, all right, so the cooktop costs 40,000, which we get from line 2. In event 5, it says that the cooktop has a useful life of 4 years and a salvage value of $4,000. So that's equal to $36,000 divided over 4 years, which is $9,000 a year. Okay, so there's your depreciation expenses. What amount of depreciation would they report? And every year they'd report $9,000. And every year, all 4 years that they actually report depreciation expense over the useful life of this product or their asset. All right, so now we want to go down here and record all this junk in this horizontal statement. All right, event 1 was the company started business by taking 60,000 in cash, which made 60,000 in assets, and that is common stock. And I hate it when I call this common stock. In the other videos I point out, I call it contributed capital, but again, I'm not an accountant. But common stock and paid-in capital, outside money came in for $60,000. It has absolutely no bearing on the revenue or expense because it's nothing to do with the business. There are no liabilities. In fact, there's no liabilities in any of these questions because it was all equity transactions or revenue and expenses. In the cash flow statement, we would have to reflect the cash showing up. Okay, that'd be $60,000, and this is in financing activities. We're selling new shares of stock. Event 2, we purchased a new cooktop that cost $40,000 in cash. Okay, so that's a negative $40,000 in cash. But now we have the book value of an asset. All right, but it really didn't affect liabilities, common stock, equity, revenue, or anything else because the cash flow is we just switched from the cash in the checking account into an asset called a cooktop that has a book value of $40,000. There was a cash flow, though, and that is negative $40,000 out the door, and that went into an investing activity. All right, Excel. That's negative 40,000. That was an investing activity. Okay, and again, anytime that we have something happen in the checking account or the cash account, it's going to flow through the cash flow statement. If nothing happens, then no harm, no foul. They earned 72,000 in cash revenue. Okay. Revenue went up by $72,000. Yahoo. That's because revenue went up by 72,000. So, and we're not recording the expense so far. Okay, I got to get my balance sheet to balance because the assets are up 72,000. So right now, that would mean that I am retaining earnings because I haven't recognized the expense yet. Okay, and yeah, that's an operating activity. But then we get to number 4. We paid 25,000 in cash for operating expenses. Okay, now again, that's just the way this book's structured. You're doing this in multiple transactions. We could have done that all in the same fell swoop, but that's okay. Minus 25,000. I'm going to enter that as a positive, so it shows a negative over here in my net income column. So for the retained earnings, that's negative 25,000. All right. Notice that the total assets over here in blue and the liabilities and equity have to keep balancing. So this goes down by 25,000 and this is 0 every time. Then the equity is the balancing act. Okay. And this would be negative 25,000 as an operating activity. And in number 5, all right, now when we bought the cooktop back here, that's when the cash flow occurred. So there is no impact on cash for event number 5. Let me see if I can get more of my spreadsheet showing up here. All right, so for event 5, what I'm going to do is reduce the book value by $9,000. And that's from that depreciation expense we calculated up here for the straight line depreciation. My asset went down by 9,000. Doesn't affect liability, so what it's got to do is affect one of these other accounts, and it'll affect, since it's an expense, oops. There is no effect on the cash flow statement, but the revenue minus expense goes down by 9,000, which means that we need to reduce shareholders' equity by 9,000. When I add up all the asset transactions here, 1 through 5, $98,000. The equity is $98,000, and of course, that's still 0. The $38,000 net income over here is also going to correspond to the $38,000 increase in retained earnings. Okay, so all these accounts related to one another. At the beginning of the year, I was carrying the cooktop with a book value of 40,000. At the end of the year, it's 31,000. Now, what happens for year 1, year 2, year 3, and year 4 for the old cooktop here? Beginning book value, depreciation expense, accumulated depreciation, ending book value. All right, this part trips people up a lot. We also got to remember that the ending book value is still going to be the cost minus accumulated depreciation. All right, so we begin the year with a book value of $40,000. We take a depreciation expense of, what in the world is that? Of $9,000. The accumulated depreciation is therefore $9,000. That's all we've accumulated at the end of the year. My cost over here, it costs $40,000 no matter what. So the ending book value would be whatever I started the book value with minus depreciation expense for the year. If I began the next year with the book value of $31,000 and I took another $9,000 depreciation, the accumulated depreciation would be $9,000 in year one and $9,000 in year two. So now the ending book value would be the beginning minus the expense for the year, but I could also check that by taking the cost less the accumulated. The cost is going to be $40,000. That's what it originally cost. And the accumulated depreciation would be $9,000 in the first year, $18,000 in the second year. So now it's down to $22,000. Let me continue this out. You start with $22,000. The depreciation expense is the same. Accumulated depreciation, $27,000. The book value would either be the beginning book value, which is the cost minus the accumulated depreciation through last year, minus this year's depreciation, but it's also going to be the cost minus the accumulated depreciation after 3 years. And in the fourth year, we end up at the end of the year with a $4,000 book value, which is the amount that the cooktop could be salvaged for or sold to somebody else. All right, I don't know why people have, I do know why people have trouble, is trying to differentiate depreciation expense, which is the number that's going to flow through the income statement as an expense each year, and the accumulated depreciation. The accumulated depreciation will be a contra asset that will reduce the book value on the balance sheet each year, okay? And so it just takes some getting used to, but understanding the terms are different, all right? Depreciation expense is the year by year by year expense of claiming depreciation expenses, which reduces net income for that year. Accumulated depreciation is just the sum of all the depreciation you've taken over the life of the asset.